All right, let's talk about a threat to your retirement that, honestly, most people never see coming. It's not inflation, it's not high fees. It's this kind of silent portfolio killer that can do its damage before you even realize what's happening. So first up, let's really dig in and understand what this hidden enemy actually is. Because before you can find a solution, you gotta know what you're fighting. One analyst put it perfectly. The deadliest enemy is the one you don't see coming: sequence of returns risk. Now, I know that sounds super technical, like a real mouthful, but the concept behind it, it's devastatingly simple. Here's the deal. It's not about your average return over, say, 25 years of retirement. It's all about when the bad years happen. Think about it. If a big bear market hits right when you start taking money out, you're forced to sell your investments when they're down, which just guts the nest egg that's supposed to last you for decades. This is the part that's just wild. You could have two people retire with the exact same pile of money. They could even get the exact same average return over their entire retirement. But one runs out of cash and the other is totally fine. The only difference? Bad timing. One got hit with a down market early on, and the other got lucky. So how do you fight something like bad luck? How do you fight bad timing? Well, financial planners have a lot of different strategies, but today we're going to look at one specific tool that was built to tackle this exact problem. And that tool is the Amplify CWP Enhanced Dividend Income ETF. The ticker symbol is DIVO. This is an actively managed fund, and it has a very, very specific mission: to generate a steady stream of cash flow to help you ride out those storms in the critical first few years of retirement. So let's just take a quick peek under the hood. DIVO holds a pretty focused portfolio, only about 20 to 30 big blue chip stocks. But look at that 5-year beta. It's around a 0.70. Now, for anyone who's not familiar, a beta under 1 suggests that the fund has historically been less volatile, less bumpy than the overall market. And that, right there, is a key piece of its design. So, what's the secret sauce here? How does DIVO actually create that cash flow that helps you avoid selling your stocks at the absolute worst time? Well, it's really a 3-part engine. First, it starts with a solid foundation of great dividend-paying companies. That gives you a steady baseline cash stream. Second, and this is a really clever part, the managers sell what are called covered call options. You can kind of think of it as getting paid a little bit of cash today in exchange for agreeing to sell a stock if it hits a certain high price later. It basically turns market ups and downs into income. And third, that focus on stable, blue-chip companies is all about softening the blow when the market gets ugly. And you can see how this all plays out when you look at the returns. The number that should just leap off the page is 2022. That was a brutal year for the stock market, right? But DIVO was only down 1.5%. That is that buffering effect in action. It's designed to cushion you from exactly the kind of damage that sequence risk loves to inflict. But of course, there's no perfect investment. Come on, let's be honest. Every single strategy comes with a price. And to get that kind of downside protection, you have to be willing to make some trade-offs. So what are you giving up? Well, first, that covered call strategy that generates all that nice income, it can also cap your gains if the market just goes on a crazy tear. Second, you're only holding 20 to 30 stocks. It's a concentrated bet, not a super diversified index. Third, you are paying a higher fee for that active management. And finally, the income it kicks off can be a little complex when it comes to taxes. To put it into perspective, let's just quickly compare it to another really popular income ETF. You've probably heard of JPI. DIVO strategy is very focused: concentrated portfolio, single stock options. JPI is much broader, using a huge basket of stocks and this complex thing called an ELN. So what does that mean? Well, JPI often has a higher yield and a lower fee, but it's a totally different risk and return profile. They're both tools, just built for slightly different jobs. And let's just dig into that tax complexity for a second. In one of its recent monthly payouts, a whopping 78% was classified as return of capital. Now, what is that? You can think of it as the fund basically just handing you back a piece of your original investment. It does mean you defer taxes now, but it also lowers your cost basis for later. It's not inherently a bad thing, but it's a detail you absolutely need to be aware of as an investor. Okay, and this part is really important to remember. DIVO isn't some magic bullet that solves everything. It's designed to be one component, just one layer of defense in a much bigger retirement strategy. So a really robust plan to fight this sequence risk looks something like this. You have a cash bucket for all your immediate needs, then a bond bucket for the next few years out. And then you have your income-focused stocks, and that's where DIVO fits in. Its job is to generate cash to refill those other buckets. And the whole thing is wrapped in a flexible withdrawal strategy, where you just agree to tighten your belt a little bit in the down years.
So ultimately, the big takeaway here is this. You're not just buying a single fund. You're trying to build a system that's designed to make sure you never, ever have to sell your growth investments at the worst possible time. And DIVO's role in that system is to be the cash flow engine that helps make it all work. And that really brings us to the final question. It's not just about how much money you've saved. It's about how you've structured it. So I want you to take a hard look at your own plan. Is it truly built to defend against the one risk that can do the most damage, the devastating risk of just plain bad timing?